Want to boost sales without increasing your inventory risk? Consignment accounting is the answer. It's a smart way to get your products in front of more customers without the traditional burdens of stocking and selling. Think of it as a partnership. You, the supplier, give your goods to another business, the retailer. They then sell those goods on your behalf. You only get paid when your products fly off the shelves. Consignment accounting might seem complicated at first, but don't worry, we've got you covered. This guide will break it down, step by step. Get ready to unlock new markets and maximize your profit potential with consignment accounting. In the world of consignment, there are two key players, the consignor and the consignee. Understanding their roles is crucial. The consignor, this is the owner of the goods, the supplier. They give their products to the consignee to sell. Think of them as the product provider. The consignee, this is the retailer, the one who agrees to sell the consignor's products. They don't own the goods but act as a selling agent. The relationship between the consignor and consignee is built on trust and mutual benefit. The consignor gains access to a wider market, and the consignee gets to offer more variety without the upfront inventory costs. Like any specialized field, consignment accounting has its own lingo. Understanding these terms is crucial for anyone involved in the consignment process, whether you're a consignor, consignee, or just someone interested in the field. Let's break down some common terms you'll encounter, starting with the basics and moving on to more specific concepts. Consignment. This refers to the arrangement where the consignor provides goods to the consignee for sale. The consignor retains ownership of the goods until they are sold by the consignee. Consignment goods. These are the products sent by the consignor to the consignee. They remain the consignor's property until sold. This means that the risk and rewards of ownership stay with the consignor until the actual sale takes place. Consignment invoice. This document is sent by the consignor to the consignee detailing the goods shipped. It's not a sales invoice as the ownership hasn't transferred yet. It serves as a record of the goods that have been consigned and helps in tracking inventory. Consignment commission. This is the fee the consignee earns for successfully selling the consigned goods. It's usually a percentage of the selling price. The commission incentivizes the consignee to sell the goods efficiently and at the best possible price. Consignment expenses. These are costs incurred by the consignee directly related to selling the consigned goods, like advertising or storage. These expenses are typically deducted from the sales proceeds before the consignee's commission is calculated. Understanding these terms will make navigating the world of consignment accounting a breeze. With this knowledge, you'll be better equipped to manage consignment transactions, ensuring clarity and efficiency in your business dealings. People often confuse consignment with a regular sale. While both involve selling goods, there are key differences. This table highlights the distinctions. Ownership transfer. When the goods are sold to a customer versus at the point of sale. Inventory risk, borne by the consignor versus transferred to the buyer. Payment to seller upon sale of goods versus at the point of sale. Sales recognition. When goods are sold to a customer versus at the point of sale. Consignment offers flexibility and reduced risk for both parties, unlike a regular sale. Section 5. Accounting for consignment, a step-by-step guide. In this section, we will delve into the intricacies of consignment accounting, breaking it down into manageable steps to ensure clarity and precision in your financial records. Consignment accounting might seem tricky, but it's manageable with a clear understanding. By following a systematic approach, you can ensure that both the consignor and consignee maintain accurate and transparent records. This not only helps in financial reporting but also in building trust between the parties involved. Here's a breakdown of the entries from both the consignor and consignee's perspectives. Consignor's books. The consignor, who sends the goods, needs to make specific entries to reflect the movement and sale of goods. 1. Goods sent on consignment, debit consignment out, an inventory account, and credit inventory. This entry reflects the transfer of goods from the consignor's inventory to the consignment account, indicating that the goods are now with the consignee. 2. Expenses incurred on consignment, debit consignment out, and credit cash or the relevant expense account. These expenses could include shipping, insurance, or any other costs directly related to the consignment. 3. Cash received from consignee, debit cash, and credit consignment out. This entry records the receipt of payment from the consignee for the goods sold, reducing the consignment account balance. 4. Commission payable to consignee, debit consignment out, and credit commission payable. The consignee earns a commission for selling the goods, and this entry reflects the amount owed to them. 5. Profit or loss on consignment. Calculate the profit or loss by comparing the selling price with the cost of goods and expenses. This step is crucial for understanding the financial outcome of the consignment arrangement. Consignee's books. Now let's look at the entries from the consignee's perspective. 1. Receipt of consigned goods. No entry is passed as the consignee doesn't own the goods. The consignee merely holds the goods on behalf of the consignor until they are sold. 2. Sale of consigned goods. Debit cash and credit consignor's account. This entry records the sale of the goods and the corresponding payment received, which is owed to the consignor. 3. Expenses incurred on consignment, debit consignor's account, and credit cash or the relevant expense account. These expenses are typically reimbursed by the consignor, so they are recorded in the consignor's account. 4. Commission earned, debit consignor's account, and credit commission income. This entry reflects the commission earned by the consignee for selling the goods. 5. Payment to consignor, debit consignor's account, and credit cash. This final entry records the payment made to the consignor for the goods sold, settling the amount owed. By following these steps, both parties can maintain accurate records of the consignment transactions. This ensures transparency, accountability, and a smooth financial relationship between the consignor and consignee. Proper consignment accounting not only helps in financial management, but also strengthens business partnerships. Section 6. Handling the unexpected, abnormal, and normal loss. In any business, unforeseen situations can arise. This is especially true with consignment, where goods are often held at a location outside the consignor's control. It's important to understand the different types of losses. Normal loss. This refers to the expected loss of goods due to factors like spoilage or evaporation. It's considered a part of the cost of doing business and is factored into the selling price. Abnormal loss. This is an unforeseen loss beyond the normal expectation. It can be due to theft, damage, or other unforeseeable events. The consignor bears the loss of abnormal loss. When an abnormal loss occurs, the consignor needs to adjust their inventory records. The value of the lost goods is usually written off as an expense. Section 7. Real-world consignment, a practical example. Let's say you're a furniture maker, the consignor, who partners with a home decor store, the consignee. This partnership allows you to showcase your products in a retail environment without the upfront costs of opening your own store. The home decor store benefits by offering a wider range of products to its customers without having to purchase the inventory outright. You send them 10 chairs, each costing you $50 to make, and agree on a 20% commission on each sale. This means that for every chair sold, the store keeps 20% of the sale price as their fee for selling your product. The store sells 8 chairs for $100 each. This is a great outcome because it means most of your inventory has been sold, and you can now calculate the financial results of this consignment arrangement. Here's how the accounting looks. Consignor. First, let's look at the cost of goods sold. Cost of goods sold. 8 chairs times $50 equals $400. This is the amount you spent to produce the chairs that were sold. Revenue. 8 chairs times $100 equals $800. This is the total amount of money generated from the sales of the chairs. Commission expense. $800 times 20% equals $160. This is the fee you pay to the store for selling your chairs. Profit. $800 minus $400 minus $160 equals $240. This is your net profit from the consignment arrangement. Now let's look at the consignee's perspective. Revenue. $800. This is the total sales revenue from selling the 8 chairs. Commission income, $160. This is the store's earnings from the commission on the sales. This example illustrates how consignment allows both parties to profit while sharing the risks and rewards. The consignor benefits from increased exposure and sales without the need for a physical storefront, while the consignee enhances their product offerings and earns commission income. This mutually beneficial arrangement can be a powerful strategy for both small businesses and established retailers. Section 8. Consignment Accounting. Mastering the essentials. Consignment accounting, while having its own set of rules, is a valuable tool for businesses looking to expand their reach and minimize risk. By grasping the roles of the consignor and consignee, understanding key terms, and accurately recording transactions, You can leverage this method effectively. Remember to account for normal and abnormal losses, and always have a clear agreement with your consignee. With this knowledge, you're well on your way to mastering consignment accounting and reaping its benefits.